In fundamental market analysis, there isn't a single, best indicator because it depends on the context of what you are analyzing, whether it's a company, sector, or economy. However, certain key indicators are widely regarded as the most effective for gauging the financial health of a company or the overall market condition. 1. Earnings per share, EPS. What it is? EPS measures the profitability of a company on a per-share basis. It is calculated by dividing the company's net income by the total number of outstanding shares. Why it's strong? EPS helps investors understand a company's profitability and growth potential. A consistently increasing EPS is a good sign of financial health and indicates that the company is increasing profits without significantly diluting shareholders. 2. Price-to-earnings ratio, P/E ratio. What it is? The P/E ratio compares a company's current stock price to its earnings per share. It is widely used to determine whether a stock is overvalued or undervalued relative to its earnings. Why it's strong? A low P/E ratio might indicate that the stock is undervalued, while a high P/E could suggest overvaluation. However, it is most useful when compared to the P/E ratios of companies in the same industry or historical averages. 3. Price-to-book ratio, P/B ratio. What it is? This ratio compares a company's market value, share price, to its book value, assets minus liabilities. It helps assess whether a stock is trading above or below its actual worth. Why it's strong? It's especially useful for value investors looking for companies trading below their intrinsic value, particularly in sectors like financials or industries with large asset bases. 4. Debt-to-equity ratio. What it is? This ratio compares a company's total debt to its total shareholders' equity. It helps assess a company's financial leverage and risk. Why it's strong? A lower debt-to-equity ratio means the company relies less on borrowing and has a more solid financial footing. A higher ratio might indicate financial risk, especially if interest rates rise or cash flow tightens. 5. Return on equity, ROE. What it is? ROE measures how efficiently a company generates profit using shareholders' equity. It is calculated by dividing net income by shareholders' equity. Why it's strong? A higher ROE indicates that the company is effectively using the capital invested by shareholders to generate profits. Consistent growth in ROE is a sign of a well-managed, profitable company. 6. Free cash flow, FCF. What it is? Free cash flow is the cash generated by a company after covering capital expenditures. It's an important measure of profitability and financial flexibility. Why it's strong? FCF indicates how much cash a company has to reinvest in its business, pay down debt, or return to shareholders through dividends and share buybacks. Companies with strong FCF are often more resilient during downturns. 7. Dividend yield. What it is? This is the annual dividend payment divided by the stock's current price. It shows the return on investment in the form of dividends. Why it's strong? A high dividend yield is attractive to income-focused investors, especially in stable industries. However, it should be sustainable. A very high yield could indicate financial distress. 8. Gross domestic product, GDP. What it is? GDP is the total value of goods and services produced within a country during a specific period. It's a key indicator of a country's overall economic health. Why it's strong? GDP growth is a strong indicator of the broader market and economic conditions. Increases in GDP signal an expanding economy, while declines can indicate potential recessions or downturns, affecting both stocks and bonds. 9. Interest rates, federal funds rate. What it is? Interest rates set by central banks, like the Federal Reserve, are a key driver of the cost of borrowing money for businesses and consumers. Why it's strong? Rising interest rates can lead to reduced consumer spending and higher costs of borrowing for companies, slowing growth. Conversely, lower interest rates encourage investment and spending, which can drive market growth. 10. Unemployment rate. What it is? The unemployment rate measures the percentage of the workforce that is unemployed and actively seeking employment. Why it's strong? Low unemployment usually indicates a strong economy and increasing consumer spending, which benefits corporate earnings and stock prices. Conversely, high unemployment can signal a weakening economy. Summary of top fundamental market indicators. Conclusion. The best fundamental indicators often depend on what aspect of a company or market you're analyzing. For company-specific analysis, EPS, ROE, and free cash flow are key to assessing profitability and growth. For macroeconomic analysis, GDP, interest rates, and unemployment rates provide broader insights into market conditions. A comprehensive analysis usually combines these indicators for a clearer picture of both a company's financial health and the overall market environment.